Japan is on the brink of failure as the yen continues to crash. I'm your host, Steven Van Metre, and thanks for joining me today. And experts around the world are warning that if the Bank of Japan continues down its current path, that they could just break their own monetary system. Let's pick the story up when we head over to Bloomberg. The headlines is Japan starting to crack as the yen tumbles with stocks and bonds. Bonds sell off and stocks drop as Japan lags the Fed's tightening, who's set to tighten tomorrow. With the yen at a 24-year low, Tokyo stocks down the most since March and bond yields hitting its ceiling. The Bank of Japan is under duress for having to defend a policy the rest of the world is quickly moving on from. In his clearest warning yet, the yen's weakness, BOJ Governor Kuroda said Monday that the recent abrupt slide in the currency is bad for the economy, while the central bank reinforced efforts to keep a lid on yield. So it's funny that he's saying that a slide in the yen is bad news, and yet his own policies are leading to a weaker yen. The downward pressure on the yen and slide in Japanese government bonds was triggered by a new wave of selling in global debt markets led by treasuries as investors shocked by Friday's U.S. inflation data priced in aggressive policy tightening by the Federal Reserve and sought refuge in the dollar. Now, this is really interesting that we're seeing a flight to safety in the dollar, something many people said would not happen. We're not seeing cryptocurrencies, we're not seeing gold, we're not seeing other assets. We're seeing money flow to the dollar, and what's notable, we're seeing people sell off government bonds, and all a U.S. Treasury is a claim on future dollars. They're considered future dollars. You buy a Treasury today, what do you get when it matures? You get dollars. So what the market is trying to tell you right now is it believes the safety is in the dollar, but it also believes at the same time that future dollars are going to be considerably weaker, and they're pricing in high inflation on that story. But imagine you're sitting on bonds in your portfolio right now and you're concerned. Well, think about this. When inflation rolls over and heads lower, as we've made the case time and time again, what's going to happen to those expectations of higher interest rates? Well, they're going to come crashing down, sending bond prices and future dollars in the same notion higher. Now let's continue a story. Let's take a little segue back to yesterday's story where we talked about the University of Michigan and consumer sentiment, and we'll overlay now the Wilshire 5000 price index on a year-over-year rate of change. And notice again, as sentiment comes down here in blue, what do we see in red? The equity markets. And you'll notice that sentiment often leads the market because the market just doesn't believe that things can be getting bad, and by the same time, it doesn't necessarily buy that they're getting better yet until they do. But look at treasury yields. We take the same chart and overlay 30-year treasury yields on a year-over-year rate of change. We see the same trend that when sentiment's rising, we would expect that yields are rising as demand for money is increasing. But notice that when sentiment crashes, that so too do yields. And there are periods like this one here in 2010 that was an outlier where the market thought inflation and yields were going to rise and they came crashing down. And notably now we have sentiment falling as yields rise, putting the notion together that this idea that future dollars are going to be worth less, well, it just isn't going to happen. But the market is betting big on that, and they're going to be wrong. And now let's head back to Japan, where things continue to go wrong. And while Japanese authorities have stepped up warnings, there are few tools available to stop this momentum. The environment remains ripe for speculators to drive the dollar yen higher. So it's saying, hey, we're going to put more people are going to be in this dollar trade. That's going to be highly disinflationary for the U.S. As Kuroda's statement to Parliament ahead of a policy meeting on Friday also included a reminder that monetary easing is needed to continue. Earlier, the BOJ stepped up efforts to defend its easy stance, saying it would buy another 500 billion yen worth of bonds on Tuesday to keep rates low. And that's after the 10-year bond yield rose above its ceiling of 0.25% for the first time since January 2016. The BOJ will now need to explain clearly what the logic behind the cap is and whether that level is appropriate under the current environment. Well, it's really simple. What they're doing is they're trying to stoke inflation. And if you can get people to believe inflation is coming, they will go out and spend as if it is, and that will create inflation. The other way you can do it, well, you can just devalue your currency until you get inflation, and that's what Japan's doing here by putting a cap on its interest rates, is devaluing its currency as other central banks set to tighten. But what are the ramifications of this? Well, let's head over to Deutsche Bank, where they headline in their recent piece, the printer is on overdrive. And the Bank of Japan bought more than 1.5 trillion yen of government bonds to defend its yield curve control target. If the current pace of buying persists, the bank will have bought approximately 10 10 trillion yen in June. To put that number in context, it's roughly equivalent to the Fed doing more than 300 billion of QE per month when adjusting for GDP. This is a truly extreme level of money printing that, given that every other central bank in the world is tightening policy, is one of the reasons why we have a bearish outlook on the yen and why we have long argued that currency intervention in this environment is simply not credible, given it is the BOJ itself that is the cause of the yen weakness. So again, you start to look at what the Bank of Japan is trying to do, and for decades they haven't been able to create inflation. Well, now against everyone tightening, they're going to ease, and one way or the other, they're either going to blow their system up or they're going to get the inflation they want. But is getting the inflation they want a good idea? Well, maybe not. As we continue with Deutsche Bank, who says more broadly, we worry that the currency and Japanese financial markets are in the process of losing any sort of fundamental-based valuation anchor. The more global inflation picks up, the more the BOJ prints. The more easing accelerates, the higher the need to press hard on the brake when inflation cliff approaches, and the more dangerous it becomes. We're worried we may enter a phase where dramatic and unpredictable non-linearities in Japanese financial markets would kick in. It becomes obvious to the market that the clearing level of JGB yields is above their quarter basis point target. What is the incentive to hold bonds anymore? Will the BOJ absorb the entire government bond market? What is the fair value of the currency? And you can start to get an idea with these questions is there's lots of concerns of what's going on in Japan and how it could have massive repercussions to the point where there's questions being asked because even the experts aren't sure how this plays out. But the fear is Japan's going to get inflation, but to get so much of it, they're going to have to slam on the brakes, somewhat just like the U.S. is doing now. And that is going to cause everything to get throttled in the other direction, perhaps in the U.S. and eventually Japan and the rest of the world into a deep recession. But the gaffe or message is Kuroda remark on prices, hints of BOJ's plans, as many want to know what is going on, as a controversial remark by the Bank of Japan's Governor Kuroda has made waves across the country, as some consider a subtle message that the central bank may be starting to explore an eventual end to a large-scale monetary policy. Yeah, good luck with that. It all began with a June 6 speech where he said that Japanese households' tolerance of prices has been increasing. So here you get a glimpse of the governor saying, look, we're trying to get people to accept these higher prices. And if we can get them to accept that, and higher prices are coming after that, they will start spending money now to avoid paying higher prices later, and that's how you get inflation. As I mentioned earlier, there's two ways. You can forcibly create it through a deval, or you can get people to believe it's coming, and you can see Kuroda wants people to believe inflation is coming. Supply side constraints due to the recent lockdowns in China pose risk for a Japanese economy that struggled to fully bounce back from the coronavirus. The top priority for the bank is to persistently continue with the current aggressive monetary easing, Kuroda said, reiterating that the BOJ's official position that a debate on scaling back would still be premature. And Kuroda later backpedaled on his remarks as a Monday meeting of the Upper House Budget Committee. The governor said he understood that households are being forced to make the difficult choice to accept higher prices. His earlier comment was, well, it's just not appropriate. And if there's one thing that you shouldn't be concerned about, and that's if Japan blows up their monetary system, or in the process of all of this throttling back of QE and stimulus, that the global economy hits a recession, well, it shouldn't hit your portfolio that bad. Be sure to check out, I'll put a link up here to Portfolio Shield and one in the description below. Strategy that shined during the great financial crisis is likely again, because there's more bad news coming for the equity markets, as one of the biggest buyers in stocks is about to go on a vacation. And one bank spots more bad news as buyback blackout begins today. An analyst from Goldman Sachs Global Market Division told clients on Monday that the U.S. corporate blackout window starts today, as corporates have been the largest buyer of U.S. equity so far this year with $1.3 trillion in authorizations. Really, this isn't what bulls and those who have been tempting to buy the dip want to hear, as the S&P 500 tumbles into a bear market. And at a time, we're now starting to see the small business optimism just isn't getting any better, signaling that perhaps the U.S. economy is much closer to recession than many believe, and with the stock market likely to head lower as the biggest buyer takes a vacation, well, that is baked into a big cake of disappointment. And here we see the National Federation of Independent Businesses Small Business Optimism Index down slightly in May, as owners' expectations for the future are now at a 48-year low. And 28% of owners reported inflation was the single most important problem in operating their business, as a net percentage of owners are now raising their selling prices. And of course, this is going to be a big concern for business owners as they see the market come down and they are forced to raise prices to keep up with inflation. Well, they already know that the Fed wants to cut demand, and that's going to impact their pocketbooks as their shelves don't run out and stock just stays where it needs to be and not in consumer pockets where it should be. Inflation continues to outpace compensation, which has reduced real incomes across the nation, as small business owners remain very pessimistic about the second half of the year, as those supply chain disruptions, inflation, and labor shortages are not easing. But what's going to happen is inventory is going to build up on shelves, and small businesses are going to find out that they don't need all those extra employees. They'll start pulling those job postings as we talked about, and eventually start to lay off as the cycle rolls the other direction. And perhaps in a sign that things are starting to cool off in the consumer price area, we see U.S. producer price inflation hovers near record high as energy costs dominate. And looking at the producer price index, it was up 0.8% in May and slowed slightly down to 10.8% year over year from 10.9% last month. But how about the core when you strip out food and energy? Well, it was higher but missed expectations. It came in at 0.5%, and notably the year-over-year rate of change is starting to slow now a little bit from 8.6% down to 8.3%. But what's the big driver of it? Well, if we look at final demand goods, you see energy is the big contributor. And how about final demand services? Well, it's this transportation and warehousing and what needs for transportation to happen, and that is energy. Putting all this perspective is that the Fed's going to continue to tighten until energy prices come down, and it won't be until energy prices come down that we'll eventually see consumer prices fall. And until that happens, well, don't expect the Fed to throttle back anytime soon. Expect them to continue, and we'll cover that, of course, tomorrow. As we know, the Fed's announcement with a likely 50 basis point hike and the official beginning of quantitative easing. The only question will be is what's coming in July and then in the next meeting in September. I'm Steve Van Metre. Thanks for joining me. Thanks for being fans. Bye now.